let's compare the old way versus the way we build and manage a portfolio. Let's start with the old way. This starts by determining your maximum tolerance for risk, which then matches up with a portfolio that holds a certain amount of stocks and bonds. More stocks if you're more aggressive, and more bonds if you're more conservative. And that's it. It's all about maximizing risk. Okay, well, what is the old way to manage a portfolio? Well, they're not managed at all. They're completely blind to what's going on the markets. How is this approach supposed to work? Well, say they're invested in a couple different areas and a few of them are going down. They're hoping that the return from the rest of the portfolio will make up for it. But there's two problems with investing this way. First, when markets crash, just about everything goes down together. For example, a portfolio of 10 markets, you might find that only 2 will do okay and the other 8 are going down. And the truth is that diversification fails when they need it to work the most. The second problem is that rebalancing causes them to actually invest more in markets that are doing the worst. Think about this. Let's say their original portfolio is half in stocks and half in bonds. Let's say a crash starts to unravel and stocks start to drop. So their proportions are going to change and they'll end up with less in stocks and more in bonds, which is actually a good thing. But the old way is to rebalance back to 50-50. So what this means is that they'll be selling a portion of the bonds that were doing well and then actually adding to the amount in stocks at exactly the same time that they're doing the worst. So not only are they blind to market trends, but they're actually investing more in markets that are doing the worst. So by now, you might be asking the same thing we did. Why would we allocate anything to the markets going down? And why would we want to compound the problem by adding more to the ones doing worst? So at Stockbridge, we take a different approach to building and managing a portfolio. How do we build a portfolio? We're all about understanding your goals first and then taking the least amount of risk to get you there. Once we know what you're trying to accomplish and the time frame to do it by, we'll build a portfolio that takes the least amount of risk to reach your goals. Compare this with the old approach, which starts by asking how much risk you can tolerate. What about the ongoing management of the portfolio? Well, what academics have found is that markets going down tend to keep going down and that markets going up tend to keep going up. In other words, markets have a momentum to their direction. So what our proprietary momentum strategies will do is rank markets based on their trend, cut out the ones that are dropping, and invest in the ones rising the most. That's also how we protect from crashes, because what happens in a crash is when, say, 8 out of 10 markets are dropping and only 2 are staying flat or rising, our systems will kick out the 8 that are going down and only invest in the few that are going up. That's the power of using momentum strategies, and that's what we do. Which approach makes more sense to you? The old way maximizes risk, doesn't pay any attention to what's going on in the world, and actually invest more in markets that are doing the worst. Or you can use our approach, where we'll understand your goals, take the least amount of risk to get you there, adapt to markets as they change, so that we can protect your wealth and help you keep making progress. Contact us today for a complimentary comparison of how we can help you reach your goals safer, faster, and easier.